So after a two-day heady rally, markets are pausing, consolidating. Mid-cap index also absolutely unchanged. The big gainers today on the way up, Shriram Finance, that continues to rally, 940 on that. Of course, the day gain today is far more modest, just up close to about 0.5%, but it's added on a significant bit over the last two trading sessions. You've got a Coal India, SBI Life, Cipla, where you're seeing some modest gains, up close to about 0.3, 0.5%. Coal India has now moved to the top Nifty gainer. On the way down, I think the only notable profit booking is visible in IT names. The Nifty IT index had gained for 4 consecutive trading sessions on expectations of Fed rate cuts going into 2026 as well. So IT was rebounding after oversold levels. But today you are seeing correction, profit booking. The top 3 Nifty losers, Infi, Tech Mahindra, TCS, all belong to the large cap IT pack. BEL, where Elara Securities was just telling us very bullish. Their target, sorry, that was BEML. BEL is seeing a bit of a correction. That's down also close to about 0.5%. The rise in crude prices is putting a bit of a pressure coming on Asian Paints. Sun Pharma, HDFC Life also opening in the red. On the way up, you've also got now Coal India. We spoke about that. That's up 1%. L&T, Interglobe Aviation seeing buying. And metals, clearly the sector of the year. The metal index is up 23% year to date. And today, buying is visible in Hindalco. Hindalco this month only has added nearly about 8%. But quiet, it's flat for now. It's a red tick. But let's see as the day progresses whether we can pick up some momentum on the way up. Volumes too are on the thinner side, and today is the Nifty weekly expiry.
Well, that's right. The point on metals at the start of this month, we had highlighted that aluminium could be, one of those metals to track, which was actually underperforming. Hindalco, as Rima mentioned, is up 8%. Nalco, I think, is up more than 10%. And Vedanta, obviously, that demerger got the green signal. That as well is up close to around 10%. So that aluminium trade clearly is working out. I'll tell you the stock of the morning. It's Chola Investment. And the reason is because that much feared report with regard to pointing out various, shortcomings, that's not as bad as expected. In fact, the street has made those shorts scamper for cover. The stock is up 4.5% as we speak. Massive up move is what we're seeing out there. Yesterday, the short addition was close to 10%. Today, all of that is, there is some unwinding out there, and there is some unwinding of those short positions. Explains why the stock has moved up. Ambuja Cements holding in the green with a gain of close to around 3%. But ACC, well, the street always expected the ratio to be in favor of Ambuja Cements. It trades at a discount, but no interest at all in that stock, despite having very, very favorable valuations. Dalmia Bharat up 1.4%. You have Coforge is down close to around 5%. Infosys is coming for a bit of a breather. So that stock is well under some pressure. Canada HSBC Life Insurance, the stock is up close to around 9% and the volumes are very, very high. So that one should come up for you on the screen. And Bellrise, promoter entity had to sell some shares. That large trade got cleared out of the way. Stock up close to around 7.5%.
Yes, in fact, I think after Bellrise, the other big stock that you need to watch out for from the broader markets is Anthony Waste. So that stock is up around 9% and volumes are picking up on that one as well. And it's rallied quite significantly in the past couple of days, though year to date the performance hasn't been great. We have Orient Cement, which is up around 7%. We have Sangvi Movers, where there was news on that one as well. So that stock is up around 5.5%. Ircon is seeing follow-on buying, so that stock is up around 2% from the railway space. But remember, it's an underperformer year to date. It's lost around 25%. RVNL is also seeing some amount of traction on the upside. Biocon, there was news with regards to their biosimilar. So that stock is holding with a gain of around 0.8% at this point. On the downside, just watch out for a couple of these stocks such as Newlin Labs, Cohance Life, Pratap Snacks. Nothing really stands out considering that it's more of a quiet day. But on the upside, a couple of these stocks are definitely moving on the back of news at this point in time. Chola Investment now at the high point, up around 5% for that particular counter. We have a couple of others such as Chola Finance also, which is holding up with a gain of around 1%, unperturbed by the Cobra Post report, you'd have to say. Meesho, that one continues to decline. In fact, that stock has lost around 14% this week itself. So just watch out for Meesho. We have Grow as well, which is just about a little weak. So down around 3% of Physics Wala, which is down around 1.5%. So a couple of these new listings are taking it on the chin this morning. All of them down and out a little bit at this point.
Okay, let's get in. Trideep Bhattacharya, CIO, Edelweiss AMC, joining us on the show. Trideep, can we say season's greetings to you? I'm not sure whether we'll have one more interaction before we close out the year, but great to see you this Tuesday morning.
Good morning.
Hi, good morning. So what's the call going into 2026? And then if you could tell us about the underpinning of optimism, because 2025 has been a bit of a challenging year. So the underpinning of optimism going into next year is a pickup in earnings. What are your channel checks suggesting about how Q3 is going to shape up in terms of an EPS growth, the sectors which will lead, the sectors which will lag? And is there any risk of an earnings disappointment? I mean, tell us, based on your interactions with the managements, in Q3, what should we expect?
Sure. So, good morning. Thanks for having me on your show. And yes, one of the critical parameters that we monitor is how earnings are incrementally moving. And one of the reasons behind the consolidation that happened in the market last year was lackluster earnings. We actually cut our earnings by almost about 10 to 12% over the last year or so. And for the first time in September quarter, we saw early signs of an earnings upgrade cycle starting up. And from what I'm hearing as channel checks into the Q3, I think certain sectors more than others are certainly looking better, but net earnings are looking better than what people initially thought about. One is on the consumer discretionary side. Certainly, the checks seem to suggest that whether you look at autos or some of the big ticket consumption, the uptick seems to be sustaining. That's one. Secondly, while overall from a financial standpoint, some of the segments within financials are actually bottoming out. So we're going to see a little bit of a bounce back with regards to growth rates in the sector. These two sectors are, from the channel checks so far, seem to suggest that demand is holding good and in fact turning towards the better. IT, the furloughs have not been impacted as much. So broadly in line is what I would say. And that's what the channel check seems to suggest. So, which is good news, given what we have seen in the last few quarters. So far, the earnings season expectations for the immediate quarter seems to suggest that earnings will likely hold up, which is good news heading into New Year.
So for auto in particular, just to go a little deeper, what's the expectation of an earnings improvement? I mean, do you have more granular details? Because the sector has also done very well ever since the announcements of GST cuts. So even if earnings deliver, can there be upside in stocks from here on?
I think overall, the September quarter numbers, when they came through, while the numbers are better than expected, I think most of the estimates on the sell side didn't change all that much because everybody wanted to see that follow through onto the December quarter numbers before they change the full year numbers. That, I think, will finally come through with this quarter numbers, particularly for the consumer discretionary sector overall. And that's what I'm talking about. So I would say that, yes, versus the current estimates which are baked in, so far, I would say that we could see an earnings upgrade of about 2 to 3% come through with regards to even the expectations that we are on two sectors that I talked about, consumer discretionary and financials.
Okay, all right. Well, Trideep, just wanted to narrow down on maybe a couple of sectors. We were just discussing the entire railway space just some time ago, and it's going to be in focus going into the budget. Is that a sector which would pique your interest at all?
Not as much as in the past, is the right way to put it. I would say that overall, if you look at Modi 2.0, it was all about capital goods and different elements of infrastructure coming into third gear and fourth gear. In Modi 3.0, the party is split between consumption and infrastructure. And hence, because the overall spend is split between these two areas and little more emphasis on consumption, and we have seen plethora of measures like GST reforms, tax cuts and whatnot. And next year, we have 8 pay commission coming through. On the other side, the infrastructure investments would likely be more selective going forwards. So rather than having a broad-based spend in railways, maybe Kavach or certain components of railways will see investments and broadly at flattish level. Within infrastructure, though, the areas that we see continued strength in spend from a government standpoint will be defense. That's an area we clearly see that even Y on Y as we head towards budget, I wouldn't be surprised if the allocation toward this space increases meaningfully versus what we have been used to in the past.
All right. Hi, Trideep. Good morning and good to see you, Ben. What are you making of these newly listed companies? Lenskart, so much of debate. The stock actually has done pretty well post-listing. It could be a limited float factor as well. Grow has done pretty well. While on the flip side, something like an urban company listed, went to 200 rupees and then pulled back big time. Any of these stocks you like, which are worth looking at post the recent correction? Meesho, case in point. Stock went up big time. Yesterday it was at lower circuit with no buyers.
So, of course, we can't talk specifics, but 2 or 3 things that I would like to highlight here. One is, given how this new age IPO companies are popular at the time of the IPO, the anchor allocation and the main book allocation is hardly little, and liquidity in some of these stocks is really challenging. So I think one should evaluate the performance of the stocks, not from the listing price standpoint, but after 1 month and 3 month lock-in opens. That's when one has decent enough liquidity and true price discovery happens over a period of time. So hence, the right price discovery we will figure out over the next 3 to 4 months with regards to these IPOs. So we don't get bottom line is we don't get excited by the listing day price move. Some of these names are certainly in our portfolios. While I can't tell you the names, what I could say is that stocks which have unique business models, who have a path to profitability and unit economics are kind of in their favor, we certainly kind of look to hold them. Though I have to say that of late some of these IPOs are priced pretty finely. So we would use price declines to build our position rather than be very aggressive on a day-on-day basis is the way I would put it.
Deep, as a house, what is the call on gold and silver? Are we in for a correction after what's been an extraordinary year for precious metals? Or do you think the rally continues? And what could be the extent of any correction? Because correction is natural in the normal course of any asset.
The way I think about equities and gold, these are the 2 ways where over the medium term are good instruments to beat inflation overall. And ultimately, given that broadly, we are entering into a tariff-led world is likely to be more inflationary than what we have been used to before. Now, of the 2 asset classes, when earnings estimates are coming through, equities would tend to do quite better, would turn out to be better inflation hedge. But when earnings estimates are not coming through, precious metals do the hedge component and kind of, do well. Over the last 12 to 15 months, earnings estimates have been lackluster. And that partly explains the strength in precious metals, along with the worries about various global currencies. My sense is if we do get a sustained earnings upgrade cycle come through, equities would do better than precious metals. Of course, for that, the tariff and some of these areas which we have not resolved so far needs to resolve. But if they were to come through, then 2026 equities might do actually well, and gold and precious metals might actually see a bit of a healthy correction in the context of asset allocation.
Okay, Trideep, I don't know how much you've possibly looked at this entire GLP-1 opportunity, but it is expected to probably add 1 to 2% to the pharma growth. And all of this conversation is coming at the back of Novo Nordisk also getting approval from the FDA for a weight loss pill as compared to the injection, which is tougher to take. So just give us a sense, are you looking at pharmaceuticals in India from that lens as an opportunity?
Indeed. And we have positioned our portfolios to benefit from this. And for the benefit of viewers, while GLP-1 turned out to be the primary reason of popularity initially was diabetes and the result for that. It is obviously touched upon the far bigger market, which is the weight loss market or the obesity market, which is one of the issues to deal with. And hence, we do think that it will be globally, not just in India, a fairly popular area with a large TAM, if you may call it that way. The idea is to find those companies which can capture this opportunity profitably in their P&L and balance sheet. Indian companies particularly are looking to launch of the generic version sometime mid of next year. As and when that happens, a few companies will benefit more than others. And I can tell you, in the context of pharma, we are certainly already positioned in there and would look to kind of continue in that direction.
Okay. All right, Tradeep, we're going to let you go on that note. Thanks very much for joining in and speaking with us and giving us all of your perspective in terms of the markets. Well, for the Nifty, it's just about consolidating with a little bit of a negative bias at this point in time. Seems as though people are starting to take those holiday vacations, and you can see the volumes and the texture of the market definitely much quieter at this point. But let's get talking to a couple of companies. Mazagon Dock Shipbuilders is the next management on the show. The stock is up more than 13% in 2025 so far, and the defense major expects its order book in excess of 1 lakh crores by FY27 and margins at 15%. To discuss this, we have with us Ruchir Agrawal, who's the Director of Finance, Mazagon Dock Shipbuilders, and we will be focusing on 3 main points. First is profitability outlook and provisioning overhang. 2, order book targets, update on major tenders and execution concerns. And finally, strategic diversification plan, de-risking revenue concentration. So these are 3 of the points that we will be focusing on in today's conversation. Mr. Agrawal, thank you very much for taking the time out. First, just wanted to start by discussing about this large order award of the P-75 Scorpene submarines. What is the status of that? Because there is concern that it is yet to materialize at this point in time, and it has been delayed versus what the company had guided.
Good morning, viewers. And as far as P-75 Scorpene contract is concerned, it is still live, and Navy is finalizing the deal for that. But we have not been called for any negotiations so far. It is still on. We can only say that the deal is still on, and we expect that by, say, end of the FY26, we should hear some good news for that.
What's the size of this particular order, sir, if it comes through by the end of FY26?
We expect, but the negotiations have still not started, and it will take time. So it may be.
Okay, I think we've lost the audio for Mr. Agrawal.
By 27, yes.
Sorry,
yeah, go ahead. If you could just repeat what you were saying.
I'm saying that we have still not been called for any negotiation for CNC negotiation for Scorpene class submarine P-75 additional, which we have to make 3 submarines. And we hope that they will be coming, and it may be by end of FY26 or maybe by early FY27.
Okay, so you're hopeful of possibly hearing about it by the end of FY26, early FY27. What is the quantum of the order, if you could just repeat that?
It will not be right on my part to figure any figure for this. And we will be knowing it closer to the deal when we get it.
Okay.
All right. Hi, Mr. Agrawal. Good morning and good to see you when the street is waiting by actually to hear about some of these large orders. But I want to quiz you on a couple of numbers that you had given us earlier. I want to know how far away from the target you are. Now, you had guided, I think, for an order book to cross 1 lakh crore by FY27. Current order book, if I look at it, it's ballpark 28,000 crores. You could correct me on that number. So which are the large orders you're expecting, say, in the next 18 months? And what will the order book look like by the end of FY26?
Order book was around 27,400 on 30th of September, which is still depleted in this quarter because we have executed many of those contracts. Now we expect that as the negotiation for 75I is already on, and before close of this financial year, we should sign the deal. And in that case, if everything goes well, our order book should be more than 1 lakh crore.
More than 1 lakh crore by FY27, correct?
No, by 26.
1 lakh. So that's in the next 3 months you're expecting so much of order inflow?
Yeah.
So from 27,000 crores, you'll end the year at 1 lakh crore of an order book. Correct, Mr. Agrawal?
We are around 25,000 now. 27 was the figure of 30th September. So we will be around, we will be exceeding something 1 lakh crore by FY26 end.
Sir, and sorry, just to go back to this to understand, other than the Scorpion submarine order, are you expecting any other large order wins which will help you plug the gap from where you are today to get to 1 lakh crore by FY26 end?
I would like to clarify that this Scorpion order we are not expecting so early because that is still not finalized. And I already mentioned this in my today that we expect that the deal is still not closed and it may come up. We have not been called for negotiation. But for 75I, the negotiation is already on. And we expect that before the close of this financial year, we will be signing the contract with Navy.
So the P75I are 6 submarines where you are negotiating for?
Yes, yes.
Okay, and you could hear on that by when you said?
The negotiation is already on and it may come anytime. But we expect that before the end of this financial year, some good news should come.
And the quantum of the order, again, if you could apprise us of that?
And the price I would not be able to tell because it is under negotiation.
Okay. You had given, sir, a guidance of 12,500 crore of a top line in FY26 and about 15% margins. Does that hold?
Yeah, we are holding with that.
You're holding with that.
And we expect that we should meet that, although challenges are there. This year, the monsoon was a little bit extended, but we expect that we will be meeting these targets.
Okay.
Other than monsoons, are there any other challenges? Could you elaborate a little bit more? If you miss the target, what could be the reasons for doing that?
Maybe I don't expect as of now what we are reviewing that we will be missing the targets. We expect that we will be achieving the targets. And let's see how these 3 months go ahead.
Correct. Mr. Agarwal, what about exports? It's a smaller proportion, I think, of your business, but you're quite optimistic on larger orders coming in. So you could tell us what's in the funnel with regard to exports, and as a percentage of revenue, what is it? Where is it headed?
As of now, we are only we have only one order in hand. That is around 715 crores. And in my earlier communication, I already mentioned that we are not earning on those contracts. In fact, we are losing on those contracts. And now when India is coming up with the big shipping infrastructure and facilities, we expect that if we are also there, then probably we will be going for more export orders from here, from this position.
Okay. Just wanted to ask about the provisioning as well, because that the reversal actually helped your profitability. Is there any kind of provisioning reversal which is expected in Q3, Q4?
I don't expect too much of reversals of provision what we made for our MPV and Coast Guard vessels, and current price at which the orders are being made. I don't think a major reversal, and I also don't expect that there could be any increase for, on those products. Almost what we provided in the
Okay, so you're not expecting...
last quarter of this year.
Okay, all right. So we're going to leave it on that note. There's a little bit of a scratchy line there. So that's Mazgon Dock Shipbuilders expecting lesser amount of provisions in the next 2 quarters. They're not too hopeful about certain projects, but they're sticking to their 1 lakh crore order book guidance, possibly by the end of FY26. Nigel, that's what the management said. So maybe there'll be quite a gap to fill in terms of getting there from here to then.
Absolutely. All right. I'll tell you what. Let's slip into a short break. On the other side, we'll get into more festive mode. We have the management of Chalet who will be joining in to tell us how's the festive season panning out and what's the outlook for the second half of the year. Stay with us.
Welcome back. In our corporate conversation now, let's invite the management of Chalet Hotels. It's the perfect time given the winter vacations and the festive season. Shwetang Singh, Executive Director of Chalet Hotels, will now be joining in. He's currently the Executive Director, but Mr. Singh will take on the role of the CEO and MD effective 1st of February 2026 for a 3-year term. We used to always speak with Mr. Sanjay Sethi, but he will transition as a part of the leadership transition, move on to being a non-independent, non-executive director from 1st of February 2026. And with Chalet, we will discuss 3 main points: holiday season demand trends, the hospitality sector outlook for next year, and financial synergies with Athiva, their wellness plan. Thank you very much, Mr. Singh, for joining in. So before we get to the big picture, what your plans are as a CEO and MD, first just give us a channel check how Q3 has been, because historically, the second half of the year is always stronger for you. You get about 55% of the annual revenues in H2. And this time, Q2 had very few wedding dates, which negatively impacted you all. So many weddings happening, seasonally strong. So Q3 in terms of revenue growth, ARR and occupancy. On these 3 metrics, what is your expectation?
Thank you. Good morning. Thank you for having me on the show. You seem very well informed with respect to how hospitality behaves. So there's not much I can add there, but I can tell you that we have had a historic November. Usually when you look at this festive season, especially Q3, it's best to look at October and November details together, because what happens is that basically the Diwali moves along with the Dussehra season, and that's typically slightly low in terms of business. So when you look at October and November together, October was steady. November was absolutely historic. It's been, from what I hear from my colleagues, it's been the same for the larger industry as well. And December is steady. So we should be coming out smelling like roses from this quarter overall. You're absolutely right. The reasons are clearly seasonality. The fact that the SIA dates, we had a strong quarter of SIA dates. It's also the time when, a lot of corporates set up their MICE, etc. So it's also good from that perspective. So overall, just the weather, the fact that there are SIA dates and there is MICE movement all put together, along with the fact that there is leisure movement at this time as a lot of people take holidays as well, turns out makes this quarter a very strong quarter. We expect a similar sort of a quarter for Q4 as well. Again, February coming out very strong. Unfortunately, January doesn't seem to have SIA dates. It typically opens up around the 14th of January. This time we have 1 or 2, but not the big ones towards the end of January. February then again is very, very strong, and March is steady. So Q3 and Q4 together should come out very, very strong. In terms of ADR and occupancy, whilst it's we don't give out specific numbers, but I can tell you that it will be comfortably in double digits and probably mid-teens overall.
So ARR mid-teens in Q3 and Q4. What about occupancy? So when you say that November has been historic, what kind of occupancies have you enjoyed?
Again, it's price sensitive data, but I can tell you that both occupancies and ADR went through the roof, and both for our leisure and business locations. So it all happened at the same time. South has been very strong for us, both Hyderabad and Bangalore. And in Bangalore, we had also added some extra number of keys at some 130 keys. And that has been very well received by the market, stabilizing pretty quickly. So actually, overall, we have had, very comfortable double-digit growths, and the overall revenue for the business, etc., and EBITDA growth will also be very comfortable double digits, and higher to senior teens actually.
Okay, Mr. Singh, thanks for joining in. Well, the 2 of the segments which actually caught my eye is your residential projects, where the revenue was up 94% on a year-on-year basis in Q2. Your commercial real estate segment was up 76% year-on-year. Yes, nascent, but your residential project is already doing around 280 crores in terms of revenue at this point. Just give us an outlook in terms of what the plan is on these 2 segments. What are the kind of projects that you're currently executing? And what is the run rate that we're expecting on these 2 segments?
Let me talk about the residential project first, because it's a one-off. It's not our main business. Right? Actually, at the time when we got listed, it was seen as a risk. But thanks to the hard work that the team put in, we have actually managed to make it a big positive for us. What you see in terms of revenue and EBITDA booking for the residential is not a steady income that you can expect going through to the subsequent quarters. basically, very at certain points in time, once you have received the OC, once you have completed more than 95% and issued the letter for possession, it's only at that time that you can book revenues. So these revenues and EBITDA tend to be clustered, and therefore please see it as a one-off. There are still 2 residential towers in that project that have still to be booked. The first set of 9 towers are already booked, and therefore there was a spurt in EBITDA and revenue. In terms of residential, again, we will not necessarily go down that business, at least as a major plan or central to what our business is. Moving on to the commercial real estate, right now we have 2.4 million square foot of commercial real estate that is in play, and we have about 900,000 that's under development. Of the 2.4 right now, we have about 76% that is occupied, and our last exit was about 26 crores per month. So if you multiply that by 12, you get basically what is the annual expectation coming from there. But as we speak, we are leasing out more. Particularly in Powai, we have some space to lease out. We are only at 77-78% occupancy in Powai. So that's going out, and that should then bring up the revenues and EBITDA in that segment as we go forward. Again, whilst it's quite central to our business, commercial real estate, but it's always been seen as sweating the asset strategy. Our central business remains hospitality, with commercial real estate only adding an ancillary revenue, but a very significant one to cover us both from an annuity income and cover us against the cyclicity of hospitality.
All right. Hi, Mr. Singh, and welcome to the show, and looking forward to interacting with you. Nigel on this side. Well, Mr. Singh, I must confess that I had a bit of a busy year personally. Couldn't take my family too far away from Mumbai, but I visited your Powai property a few times during the course of this year, and we felt we were far away from city life. Really, really good property out there. But I want to focus on a couple of other brands that you've launched. The Athiva brand, I think you've launched close to 900 keys. So tell us the positioning of Athiva, and what are the targets you've set out for this brand?
So Athiva, our first Athiva opened in Khandala. I think you were referring to Khandala, not Powai. If you've been out there, and it used to be the earlier Dukes. We have...
Mr. Singh, I had visited your Powai property.
What is the FPS today?
Yeah.
Okay. So that's
precisely, but
currently under renovation, and we hope to open that in the quarter 4 of this year.
Right.
So that's in the works. Coming back to Athiva, we are positioning it in the upper upscale segment, just below leisure. The equivalent would be a Marriott or a Hilton brand from those portfolios. Right now, we have made an announcement of 900 plus rooms, but essentially they are all our hotels. So if you see Navi Mumbai or the Aksa Beach, which belongs to the group, the two Goas or Thiruvananthapuram, they all belong already to us, and this is not a third-party play at this point in time. It's not an asset-light play. It's also I just want to make clear for our investors and for our viewers that the 900 that we talk about is part of our announced pipeline itself, barring the one at the Aksa Beach. So actually, of the 1,200 keys that we've announced in our pipeline, this 900 less 150 of Aksa Beach, less 250 of Aksa Beach is already in the pipeline. So these are not new hotels. These are only going to be branded Athiva going forward.
One number answer, sir. I think 5,000 keys is what you had guided by the end of FY26. So after your first term of 3 years, what would the number stand at? One number.
It should be comfortably more than 5,000. Although our announced pipeline is 4,600, but we have enough within the group going on within the group that should take us north of 5,000 is all I can give you at this point.
Okay. Well, a pleasure speaking to you, Mr. Singh. Wishing you, the entire team, a very, very good end to the year. And you're sounding very, very optimistic about prospects for the second half of the year. So wish you well. We catch up in 2026.
Yes, we must do that. Thank you so much.
All right, let's focus on the next corporate, Belrise Industries. That's the management on the show. The stock is buzzing in trade. There was a very large trade that took place earlier today. They have also signed a strategic agreement with the Israel-based Plasin Sasa for defense opportunities. The stock, in fact, has seen a big gain post its listing. To understand who was party to these morning trades, as well as what's the way ahead. We're joined by Mr. Swasthit as well as Sumit, the promoters of the company. Hi, gentlemen. Good morning and good to have you all in. Give us a few details, gentlemen. We understand that there was a large trade today and the promoter entity was the seller. Could you clarify on that? What was the proportion of sale? Who was the buyers? And is there an intent to further reduce stake in the time to come? I think it was 73% is what the promoters held. Post today's trade, it would come down a little bit. At what level are you all comfortable?
So I can answer the question. Firstly, I'd like to talk about why we went ahead and did this trade. So right from our first earnings call, we have guided on merging or acquire two of our related party entities. One is Badwe Autocoms and second is Exhumates. So if we were to merge both of these entities in, that would have pushed our promoter shareholding above 75%. And in that case, we would have violated the MPS norms set by SEBI. Hence, we have done this transaction in advance of the merger that we filed. And that is the reason why we have gone ahead and done this transaction as of today.
Okay.
Got it. So post this transaction, the promoter holding would have come down to around 66, 67%?
Yeah. Correct. Today, it's around 66 to 67%.
And who was the buyer today? If you could give us some color on that.
We are unable to mention that.
I thought I'll try my luck on that. But anyways, we'll wait by, once the disclosure comes in on the exchanges. Post getting the unlisted entity into the listed entity, as you had promised at the time of the IPO and various other analyst meets as well. What will the promoter holding look like?
So that will, of course, depend on the valuation that we do it on. What we have committed to our shareholders and what we think is extremely critical is that we'll be doing these transactions at or around the book value. So, which is why we feel that these transactions will be value accretive to our shareholders right on day one. And in that sense, we'll be able to reward our shareholders for the fact that they've been with us on this journey so far.
Okay. All right. Well, let's move away from that. You've now signed an agreement with an Israeli company for a defense opportunity, which could possibly fructify over the next 2 to 3 years. Just give us more details on this.
Absolutely. So we signed a strategic partnership agreement with a company called Plasan Sasa. They're based out of Israel. They're a very, very innovative company. They're a global leader in armored solutions and anti-ballistic protection mechanisms and the likes of it. And we've signed specifically for this one product called the Atom, which is a UGV, unmanned ground vehicle, which will be focusing on the Indian market in terms of the product, in terms of strategic intent to work with the MOD, but also working with Plasan to manufacture these items and products in India, as well as manufacture and supply to them for their global supplies.
Okay, but when could we possibly see revenues show up in the P&L from this particular strategic partnership? And is this going to be one of many? Just give us a sense in terms of the longer term plan, as well as when the monies will show for this particular partnership.
So, as you know, the defense space is a space which is like an elephant. So once it takes a little bit of time to move, but once it moves very surely. So in a sense that the intent is to work on this with all hands on deck. Plasan Sasa team as well as our team will be working on building or on fructifying something very soon. However, with working with the MOD, sometimes things can take time, but we're very confident of something fructifying in the near future. At the same time, this partnership allows us to manufacturing supply to our strategic partner. That can happen sooner.
What's the total addressable market opportunity on account of this partnership?
So Plasan itself is a $2 billion company globally. So it's massive and is able to garner share with all of the top suppliers in North America as well as Europe. So in that sense, the market opportunity is quite massive, not only in India, but globally. In fact, we've already started working with Plasan on supplying some components for their global exports. So that's already in progress. And we should see revenues of that in the next fiscal year.
Okay. You said Plasan is a $2 billion company, right? But now with this partnership, what is the total addressable market opportunity that you all are gunning for? Do we have a number for that?
we would not like to. So if you think about it, it really depends on what the quantum that the MOD would like to procure. In a sense, it's a large market, but we would not like to comment on a specific there.
All right,
Will the margins be higher? I mean, are you moving into higher value segment? Can you at least tell us that?
Most certainly.
So higher margins.
High values.
I mean, give us some number, right? I mean, how much higher would it be? A couple of 100 basis points, more than that? Just some color on that front. As a percentage of the mix, how much is defense likely to contribute since you're looking at de-risking the business?
So I can answer that. So defense and aerospace in general as a segment would be a higher margin business than our automotive business.
Okay.
And of course, there can be larger work cap cycles, but in the end, we expect this business to be ROCE accretive for our business. Right now, we don't have a number in mind as to what we want the share of defense and aerospace to be for us in the future. That being said, we're very confident that we want to make this segment a meaningful part of our business going forward. And all the efforts as of now are going towards that.
Got it.
Well, we're just going to try and get some more numbers from you. Just wanted a sense, because you've maintained your mid-teen revenue growth guidance for the medium term. So just tell us what the exit rate would be for FY26 and eventually for FY27, when we do see maybe defense coming through in terms of your P&L. What can we expect in terms of your guidance?
So we are maintaining the mid-teens revenue guidance as of now with stable EBITDA margins. What you'll appreciate is just this year, we've announced 4 new manufacturing facilities with discussions ongoing for a few more in the future. So in that sense, every time we launch a new facility, there is a bit of drag on margins because no facility is going to make optimal margins right from day one, which means that the potential gains that we make through higher value segments like aerospace and defense, or maybe working more in the four-wheeler and commercial vehicle sector, that of course will be an offset with all of the new growth that is coming in. So that's why we're maintaining a target of a mid-teens revenue growth in the medium term and stable EBITDA margins.
Okay. No more promoter stake required? Just one final word?
Sorry, can you repeat that?
Will the promoters need to sell further stake for all the integration amalgamation that you've planned, or this is it?
The two entities that we're planning to merge, this should be it.
Okay. And there is nothing else which is on the horizon in terms of further stake sale by the promoter?
Nothing else on the horizon.
Okay, all right, gentlemen. Thanks a lot for joining in. It seems the street was waiting for this block deal to get out of the way. And now you have the stock that's moved to the high point of the day. Wishing you all the best. End of 2025, it's been a good listing for y'all. Your shareholders would be happy as well. And those that got the shares earlier today as well, they're already sitting on some hefty gains. We'll wait by for the names.
And even the discount was not too much. I think the floor price was about 3% lower compared to where the stock closed the prior day. So even the block deal didn't take place. And this is a stock which has done well since the IPO price.
That's right. And if what a year correct is when they were listing, the bankers had an opinion and there were various interested investors as well that believe pricing should have been at the lower end, and they went with that, and the returns are there for the taking. Thanks a lot, gentlemen, for joining in. Stock now at the high point of the day, 11% higher. No, in all probability, no more selling from the promoter entity, and they had to do it because, as promised, that unlisted entity was going to be coming in there. But Chandan Taparia of Motilal Oswal Financial Services is joining in to help us out with his take. Chandan, how are you feeling today? Going to be working for Christmas? And what's the view on the market? That initial dip has got bought into. As you were prior on the screen, the Nifty is actually flattish. What's the fresh trade?
Good morning, Nigel. Thanks for having me. So yes, it seems that market is in mood to celebrate Christmas, and best wishes in advance for a fantastic festival. The good part is that we are in a range. Nifty got stuck in a range of 600 points in between 25,700 to 26,325 from last almost 30 trading session. The VIX is below 10, which indicates that the market is not in hurry to see the next leg of momentum. But yes, the trend is intact. Supports are shifting higher. Index gradually shifting its support to higher zone and recently took support near its 50-day exponential moving average. So I believe slow and steady market is gearing up towards the new all-time high territory to welcome the festivity as well as welcome the new year. So I believe till Nifty holds above 25,800, buy on decline could continue to take the indices towards 26,350 to 26,500 marks. When we talk about Bank Nifty, it is also consolidating in a broader range from last almost 7-8 weeks. Supports are intact. until it holds above 58,800. Bank Nifty has potential to continue the momentum or swing towards 60,000 marks. So slow and steady, the levels are shifting higher. Range is narrow because of the lower wicks, but trend is intact and we will continue to be with buy on decline stance. Now talking about trading ideas, a positive view on the entire metal basket. Metal and mining stocks are likely to do well. In fact, at the beginning of this series, we came out with the report about the seasonality theory that in the month of December, out of 10, 8 times the metal index remained positive. And this really worked well, and we still believe the momentum could continue. So positive view on the entire metal and mining name, whether we talk about Hindustan Zinc, NMDC, National Aluminium, Hindustan Copper and all. But here I'm recommending to buy on NMDC. It has given a consolidation breakout on the daily chart with surge in open interest volume. We have seen put writing activities, put call ratio of the counter is shifting higher. So looking for a fresh leg of rally in the counter, one can buy with support of 77 for an upside target towards 86. Second trading idea, that is buy on Glenmark. We have seen consolidation breakout and selective pharma counters are doing well. Supports are gradually shifting higher. We are expecting better rollover, and roll cost is also turning upwards. So recommending to buy with support of 2020 for an upside target towards 2150. One more trading idea, that is bottom out approach on defense counter. It seems that HL has bottomed out after the lower top, lower bottom of last few weeks. And now one can buy with support of 4320 for an upside target towards 4650 marks.
Okay, all right, Chandan, we'll leave it on that note. Thanks very much for joining in and giving us all of those tech calls. Well, Glenmark, he mentioned, is in focus also because they have launched a particular drug in the US markets. The market size around $67 million, and the drug is used as an emergency when somebody has an allergy attack. So that stock is in focus on account of that as well. We'll take a short break, but on the other side, Manisha Gupta will join in and she'll be taking us through the commodity space. Stay tuned. Welcome back. Let's shift focus to the commodity space now. Manisha is here with us to tell us what she's tracking this morning. Manisha, over to you.
Well, thank you for that. It's not just the precious metals which have been buzzing in trade. By the way, they have made yet another all-time high. But it also is about the base metal prices, which have been surging as well, and most of them heading on a positive note to end 2025. The best of the gains, of course, clearly coming in for the Dr. Copper. We've seen 39% of gains come in for that. Aluminum is trading at a 16% on the higher side. And we've seen zinc prices gain up by 3.5% as well. The first half for zinc wasn't so great, but it's commendable that we've been able to come into positive for this one. What also has done quite well has been tin prices. That, of course, is an outperformer with 48% of gains. But we haven't seen such a great comeback come in from nickel, and lead prices just about in the positive on your screens. So it really is copper, which is the hero within the metal pack. There's a reason it's called Dr. Copper. If you look at the LME prices, well, we have seen a record highs very close to that $12,000 a ton mark. When you look at the US copper prices, we saw an all-time high in the mid-year. And having said that, it's been a great time for copper this year because almost everything that you're looking at in sense of fundamentals seems to be very, very supportive. It is also headed for the strongest annual gain since 2009 on the back of outages at major mines. There are limited new project developments that we've seen in sense of reports or on ground break-in that has been supportive. When it comes to mining, well, whether it was about Chile, Peru, Indonesia, you've seen concerns come in from all of those major producing countries there. And there's no major investment seen. Deficit is expected at 19 million tons by 2050 on the back of a lack of major investments in any project. So when you look at the demand in the meanwhile, that is expected to be on a stronger side. Long-term infrastructure demand is what the markets are working with. It also has to do with the fact that there are historically low treatment and refining charges. We do understand that when it comes to China and Japan, they've agreed on zero duty, 0% TNC charges. So that tells you that there is a lack of refining metal available in the global markets there. But it also is about on the back of demand growth coming in on EVs, grid upgrades and data centers. But markets do say that it is majorly on paper because when you look at the Chinese market, there is weak demand coming in from there. It also has to do with the fact that not so much demand is coming in from Europe as well. It also is about high premium that is pushing manufacturers to cheaper alternatives. It also is about US, which has been buying a lot of copper because of expectations of a 15% duty coming in. So there is copper, just that it is not getting consumed, but it is getting stockpiled, is what the markets fear could lead to some correction going forward there. The other one really is aluminum. 3.5-year highs onto this one, 29.70. It's not too far away from its all-time highs either. And for aluminum as well, it is the Mozambique smelter, which has gone down in sense of maintenance, which is pushing the prices higher. It is about disruption at Iceland, inventories at Japanese port down by 5.5% on a month-on-month basis. And then it is about China, which also is putting out a cap at around 45 million tons. No more production than that in this year tells you that if China stays on course with this 45 million tons, you are looking at higher highs coming in for aluminum as well in the next year.
Okay, all right, Manisha. Thanks very much for taking us through the entire commodity setup. Well, for the markets, absolutely flat at this point in time. Stocks such as Chola Investment up around 6.5%. Time for a break now. On the other side, former RBI Governor D. Subbarao speaks to Lata Venkatesh on the current rupee decline, foreign fund selling, and the India growth story. Stay tuned. Welcome back. Former RBI Governor D. Subbarao was one of the few governors who saw through a rupee decline twice in his term. In the 2008 Lehman crisis, when he had just taken over, and in 2013 during the taper tantrum at the end of his term. In this exclusive chat for Money Control, Lata began by asking him if the current rupee decline is more deadly because it comes not from a current account deficit but a capital account outflow. Listen into a slice.
Historically, the rupee came under pressure because of widening current account deficit. But this time round, the pressure is coming from capital outflows. And why is that happening? Like there are several components in the capital account. There's ECB, there's NRI deposits, but the flows that are causing worry are the foreign investment, the FPI, foreign portfolio investment, and FDI, foreign direct investment. So why is there outflow of FPI? For several reasons. First, that domestic investors have come in a big way. As Anant Narayan, a former whole-time member of SEBI, wrote in a recent op-ed, the number of retail investors has multiplied 3 times in the last 10 years, from about 4.5 crore to 14 crore. So they're coming in a big way and displacing foreign investors. And foreign investors are also finding it attractive to
sell out at this time.
Sell out because valuations are high. On the other hand, on the other side, there is the attraction of AI. So people are exiting here, taking advantage of not fear of missing out on the AI boom. So all these forces are causing FPI to flow out. On FDI, I heard the chief economic advisor say in some interview recently that the gross inflows are not too bad, but it's the net inflows which are, which are causing worry, because a lot of foreign investment is going out because foreigners are, taking away retained earnings.
They're getting a very good price because...
Very good price. So I would worry not so much about the rupee going down, because the rupee is tracking fundamentals. The question we should ask is, why are fundamentals somewhat disturbing?
Yeah.
And I worry about foreign direct investment going away. Why if India is really the growth story, 7+%, etc., we are the growth story of tomorrow, why are foreign investors not continuing here? Why is domestic investment not taking place? Even domestic investors are going away. So that, I believe, is a bigger worry.
Yeah, Anant Narayan's argument, I read that edit too, and he wonders whether Indian shares are too highly priced because of this tidal wave of domestic investors. And maybe we should change taxes and make it less attractive. I don't know. But let me come to the complaint which foreign investors often tell us on the channel, that we are the only country which taxes them. So do you think now that we are actually worried they are stomping out, should we reconsider the tax on foreign investors?
See, we tax foreign outflows not for fiscal revenue reasons. No. We tax foreign outflows, capital outflows, because we want to prevent hot money from coming in, because in the past we had flippant capital come in and cause huge instability. So we don't want to open up ourselves to that vulnerability. So I believe there's a case for looking at taxation. First, capital gains tax. Foreign investors want to be able to estimate their post-tax returns with some degree of confidence. But our tax regime does not make that possible. It's not the tax rate so much, which I believe is not outrageously high compared to other emerging countries. It is the burden, tax compliance burden. There is, for example, we don't have a stable tax regime. There is different interpretations. There is discretion, a lot of discretion in interpreting the tax laws. So what I think we should do is to have a tax regime, say that this is what it's going to be for the next 5 years, have a very exhaustive list of FAQs, have somebody in the ministry who will be able to respond to queries and questions by foreign investors with some authority, so that they feel more confident about coming in.
Okay. Now, they have a complaint with our capital gains tax as well. Many countries don't have a tax on capital gains.
But on withholding tax, I believe there is a case for reducing the rate, because we don't get stabilizing long-term foreign capital because our withholding tax is too high. So there I would think that there is a case for reducing the tax rate, Whereas in capital gains tax, it is more a case of improving tax administration and the tax regime.
Got it. Do you think that this inflation targeting framework is giving Reserve Bank more freedom? In your time, remember, Mr. Chidambaram was forcing you to cut rates.
Right.
But now there are 6 people. So do you think Reserve Bank has more freedom now?
Just to put the record straight, not just Chidambaram, but even Pranab Mukherjee. So both finance ministers were putting pressure because the situation at that time was such. There was policy paralysis. The government could not do anything to push growth up. So they wanted the Reserve Bank to do something, be the cheerleader, inspire some confidence in the market. From a political perspective, quite understandable. From the technocratic perspective of the RBI, not to be done. Okay, but the question is...
if it is it better for the governor now?
I would think so. The inflation targeting framework and the MPC came into being after I left the RBI. From what I see outside, I believe it makes the RBI more independent because it's easier for the government to put pressure on one individual, the governor, rather than a committee. And there is the framework, So if the inflation breaches goes beyond the
6% mark
band, there is concern both on the government side and the RBI side, a more shared concern. And when the MPC idea was first mooted, all of us were concerned, including you, about whether the government will put their own people on the committee, to
back the committee. We worried that
to do their bidding in the committee. But over the last 10 years, members of the MPC have been very credible, outstanding economists and analysts who've been there, and MPC has established a record. So there is a plausible case that the MPC and inflation targeting framework has worked and has made the RBI more independent. But there is always the question of inflation in India, which is oftentimes from the supply side pressures. So if that happens, as is often the case, can RBI's monetary policy do the job of reining in inflation? And what does it do to the credibility of the inflation targeting framework? That question remains open. The other question, since we are on the subject, I also worry about exchange rate. Because whether we like it or not, the pass-through from exchange rate to inflation is high and getting higher. So if the MPC is tasked with the responsibility of just inflation and not exchange rate, can there be a conflict? Okay? So I think we've got to be mindful of it. Thankfully, so far, it's not been an issue, but we've got to be aware that this could sometime be an issue.
But broadly, inflation has remained under 6%. So would you say for all its frailties, the inflation targeting framework is a success?
I would think so. As I said, there's a plausible case to argue that inflation targeting has been a success. Because the circumstances which some of us had reservations, like the administered interest rate regime, a high fiscal deficit, which could undermine the inflation targeting framework, but the less of worries today. So I think the circumstances for making inflation targeting framework a success have also changed for the better.
Well, we finished exchange rate and inflation. Let me come to fiscal consolidation. One has to give credit to the current regime and to Mrs. Sitharaman. They have kept their word on bringing down fiscal deficit. But, now we see most other Western countries actually running up deficits, especially the United States. Why is fiscal deficit so important in our context? Why are we not taking liberties?
Well, first of all, for good or bad, fiscal deficit is the single most important indicator foreigners look at when they want to evaluate the credibility of government's economic management. So that's the reason why it's important. Second, I want to say that as much as Finance Minister Sitharaman has been very credible on fiscal consolidation, and she's on track to deliver 4.4% of fiscal deficit in FY26, I think it's too early to declare victory. Because our debt to GDP ratio is still quite high. For the central government, it is 60%. For the general government, it's as much as 80%. So interest payments are the single largest item of expenditure, both for the central government and for state governments. Interest payments are the fastest growing item of expenditure, both for the central government and for the state governments. And one thing people say, that like you said, look at America, look at Japan, 250% of debt to GDP, look at America, 150%, UK, 150%, EU, so on. So we can't compare because our revenue to GDP ratio is also low. So if you look at the primary deficit, etc., you realize that we can get into a debt trap at a much lower debt to GDP ratio. So we need to be worried about that.
Let me come to the growth bit, and I want to ask banking before I run out of time. You think growth has, we've got over 7% for the last 4 years now, especially if you average out. You think that we are on a structural better growth, higher growth?
That's a tantalizing question. Actually, the story is much more rosy than that. Not only do we have a 7+% growth prospects, but the current account deficit is low.
Yeah, 1%.
Inflation is low. So have we hit the Goldilocks situation? This is in contrast to past situations where we had rapid growth, but collided into inflation or balance of payments pressures, or we had stability, but at the cost of modest growth. And part of this growth with stability argument is the story of better macroeconomic management. We have the FRBM, greater compliance with FRBM. There's the inflation targeting framework, and we're less reliant on foreign capital than we were before.
Yes.
So that's the positive side of the story. But I would think that we can't declare victory. We can't say that we shifted to a structurally higher growth path because look at private investment. Capital investment is yet to take off. It's quite tepid. The job situation is quite disturbing.
That is disturbing.
Household incomes are rising more slowly than the GDP. There's productivity is not improving.
Inequality, yes.
Inequality, jobs, productivity. So there are lots of concerns. So I would think that there's cause for cheer, but not for celebration.
Okay. Not 3 cheers, maybe one or 2 cheers.
Yeah.
Let me ask you a final question, sir, on the way IAS has come into everything. I mean, I don't mean any affront to you. You also were an IAS officer who came into RBI. But now they are in RBI. They are an IAS North Block, ex-North Blocker is in SEBI, ex-North Blocker is heading IRDA. Is this good? IAS spreading its tentacles everywhere.
Give me a couple of minutes to respond to that, which is that, my response, as you said, may not be seen to be objective because I'm guilty of having been in the IAS. But the organizing principle of the IAS is that the IAS officer brings the breadth of experience because they're exposed to the world, exposed to the country, that work at the frontiers. They know the situation in the hinterland of the country. They bring that experience. When they get into a leadership position, domain knowledge is less important than the breadth of experience. They should be intelligent enough to take advice from domain experts, appreciate that, and take a decision. That's the organizing principle. Has it worked? Largely. But there have been very, very evident failures as well. So the question is, in the financial sector, like the RBI, SEBI, IRDA, is domain knowledge more important than the breadth of experience? If you take the RBI, for example, we've had IAS officers who've been outstanding governors, Mr. Venkataramanan, Dr. Y.V. Reddy, Shaktikanta Das, and now Governor Malhotra. We've had non-IAS officers who've been outstanding governors.
Rangarajan.
Dr. Rangarajan, Dr. Jalan, Dr. Raghuram Rajan. So I don't think the IAS, non-IAS. But I believe, to differ partly to you, domain knowledge perhaps is more important in the financial sector. And the IAS officers who come in should be prepared to dirty their hands because they don't know the plumbing. Like I went to the RBI right at the top. So I didn't know the plumbing of the RBI. How is regulation done? How is supervision done? How do RBI traders trade the rupee? I don't know that, right?
That's true. But you don't, when you're making decisions at that level, you don't necessarily have to know every nitty-gritty. My only worry is that we had a fairer share of non-IAS people, before. It looks like this moment, in the last 2 years, the IAS domain has increased.
If the government is, disinclined to consider non-IAS because they know the IAS officers, I think that will be net negative. So whenever opposition opens up, they should look at all possible candidates and take the best decision. Don't disqualify an IAS officer just because an IAS officer, but don't take an IAS officer just because he's an IAS officer.
Yeah, that would be ideal. And I would assume that prime ministers think that way anyways.